Right, a very warm welcome to everybody, and welcome to week 32. Hope you all had a fantastic weekend, and thanks as always for making time for our weekly cross asset call. Joining me on today is going to be the very talented James Kim, who's going to run through our charts, and covering me actually next week will be the equally talented Rhodesian Persuasion, Andrew Bresler, who will be on point as I'll be taking a much needed break off for the next kind of week. So basically, as always, these are solely views, opinions, and no trading or investment recommendations. Also, we should hopefully be getting back to the regular kind of COT report from next week as our European colleagues come back from their vacation. Last week, really, from my perspective, key pointers are a huge reversal on Friday. It was not so much that even the US data was strong. We have gotten strong US data before. It was just the fact that the market, and should I say actually the dollar in this regard, actually reacted to it, right? We saw when the PMI beats and the stronger than expected kind of GDP, no real delta. So quite interesting to see, non-farms coming in at 209 versus 180K that was expected, as well as a beat on year average hourly coming in at 2.5 versus 2.4. That was expected. It's been tracking around this 2.5 for about 4 months now. Slight tick up in participation rate, about 10 basis points, I believe. And then obviously unemployment rate again, getting tighter, in line at 4.3, but tighter than the previous 4.4. Definitely again showing again that this is a hot labor market, and there's no real kind of delta there. I think the other important thing for my note here was really on Bunds, with German 10 years getting back below that critical kind of 48.50, that it acted as quite a bit of a resistance kind of level on the move kind of up. I'm going to swing by a little quicker because I want to spend a lot of time on the positionings and different kind of books that we got. So week ahead, really, it's really all about U.S. inflation. There is also an inflation theme across the board. Of course, out here in Asia Pacific, and for the G10, it's RBNZ, which is on Thursday. I don't think the market's expecting much, neither am I personally. And again, can't underrate how important this is. Again, U.S. inflation, which is basically going to be another kind of Friday phenomena, right? So 1.8 is expected on the headline. 1.6 was the previous handle, and then we have on the core both 1.7 expected and previous. And also worth noticing that we also have China CPI out this week, FX reserves, PPI, which had started to kind of take a little bit back, but 5.6 expected there, new loans, as well as a few kind of other things. And not to, again, be forgotten, CPI expectations out of New Zealand, which is also a very big print out there. We'll also hear from emerging market central banks such as Philippines and Mexico, a few kind of Fed speakers scattered across the board. And there's a few hauls with Australia and Canada holidays today. I believe Australian market still very much trading. Otherwise, JK would have arbed the weekend. And of course, Friday, Japan should be out. And also worth noticing on Friday that we do have the RBA lows, set and due to speak. So a few copy-paste pictures from previously, especially on the big picture part. This is the whole QE theory. It was supposed to be inflationary, cause companies to invest, and it actually has done the opposite. And I think QT, which is supposed to be deflationary and cause companies not to invest, I actually feel that in practice this is going to be the opposite. So just something to kind of keep for the more structural long end of your portfolio, and for the more kind of skewed towards investing, or more medium longer term traders out there. Again, reiterating on North Korea, the incremental delta is very real. Continues to be heavily kind of discounted. We recently have had Nikki Haley basically saying the time for talk is over. We've also seen a travel ban last week, which sounds pretty ridiculous because one of those things, so I can't believe they didn't have that before, but there's an official formal travel ban, the only travel ban the U.S. has, I believe, which will be coming into play from September 1st, and asking Americans to leave North Korea. I've added fixed income divergence cometh from the FX divergence kind of theme. And again, here, this was basically saying the big run up that we had in Euro, Aussie, Kiwi, Loonie, and the congestion in yen. We're not going to be at these levels potentially on a 3 to 6 week kind of horizon, and advocating potentially 3 to 4 months kind of straddles or strangles kind of around here. continue to kind of like that expression, if you will. There's also a lot of Jackson Hole with about 3 weeks to kind of go here. A lot of strategies you could be thinking about this. Really, from my perspective, again, it's really more about ECB, Draghi, and Euro disappointment, right? So the skews that I would be looking to would be to try and play for potentially lower euro crosses, lower yields on eurozone bonds, so higher bond prices in Europe, and of course higher eurozone equities, i.e. a lower kind of euro should be helping out there, which we started to see a little bit of last week with kind of the DAX. So these are kind of the structures that I think are a little bit more interesting. I do have the Jan 2019 Fed Fund futures that we've spoken to before back on radar. Again, basically telling not just one hike. That's I think about one hike only priced between not just today and the end of the year, but actually today and the end of 2018. I would take exposure to that. As you all know, my consensus view is for upside risk towards inflation in the second half of the year and growth being a lot more robust than people are giving it credit for. Tactical kind of long baskets was an expression something I was talking to a few clients about last week, and this was in essence, I think it was Monday, Tuesday actually, where we were talking about potentially looking for the dollar bottom, but looking to express it through options so you at least know what your premiums are. And in this case, it was long dollar Swissie, long dollar Sing calls, which have actually done quite well because at the time from at the money where we were. We're talking about a 4-month expiry, but obviously you don't have to hold it for that period. You can close it after Jackson Hole or after the September 20th Fed meeting. But also was talking about long Aussie dollar calls, so kind of expecting a continuation of the commodities, saying that the China growth and demand is real, especially on the infrastructure side, as well as 10-year bond future puts. Again, this is a little bit kind of longer, expecting maybe upside surprise on bond yields once the balance sheet of the Fed starts to kind of move. And then also something like calls on XLE, which is energy ETF, continues to lag despite last few weeks moving in oil. Also the developments kind of in Venezuela. For me, it's a question of when to actually be putting this on rather than if. And of course, options is a nice way to dip your toe in the water, if you will. So there's a few trades on the tactical and the strategic book before I hand it over to our talented chartist. On the tactical book here, let's look at closed stuff. So I decided to close the long Aussie bond futures position after we hit the first target. So just close it down on Friday. And I was always a little bit kind of nervous about this kind of structurally, to be honest, and got quite a decent move a lot quicker than I expected, and just decided just to bank that and wait to kind of revisit. I'm a little bit mixed on bond price action because on the one hand, I'm expecting upside in U.S. Rates and disappointment and potential shakeout once the QT actually takes off. I think it's going to be a bigger deal than most people expect. At the same time, up until at least Jackson Hole, I'm expecting yields to kind of compress on the Eurozone kind of side of things. So it's a little bit of a mixed picture there for me. Structurally, long term, though, I still want to be short duration, i.e. expecting yields to kind of re-rate. And again, here on the Nikkei, this was really due to the closes on Friday that kind of changed at least the near-term kind of view on dollar yen. So I just decided to just close that pretty much at flat. And we can come back and kind of revisit that at some point. I think it's more just kind of a back burner play. But very, very happy with plus 60K from 10-year bond futures in Oz. Very happy there. So 3 more trades put on a tactical positioning. Short NASDAQ, as I've said now, and as JK has also been highlighting, it's probably running on 2-3 weeks where we're really feeling and looking overextended, starting to see some bearish divergences creeping into kind of the RSIs. It took me a lot of time to decide whether it was S&P or NASDAQ, but finally decided, the closing candles over the last 2 weeks here were pretty kind of bearish, going a little bit obviously at new highs here, and targeting initially 6,200 and then 6,120. If we do hit this 6,200, I will immediately be moving the stop to the entry because I just think any kind of equity pullback has the risk of potentially being kind of very shallow. The long dollar Swissie, long dollar Sing, is really just an expression of us potentially getting a tactical kind of bounce. Obviously, the risk there is this could just be another head fake, and actually we're not yet out of that bearish US dollar kind of sentiment, but we'll have to kind of wait and see. We do have these replicated in the strategic book, as you'll see. Also not on cotton, given how quickly we've kind of moved into the profit, I also decided to move up the stop level to where the entry is, so at least at least have upside. There's always pros and cons to doing this, right? Statistically, you will tend to stop out. Obviously, you have more trades because you're kind of trading your kind of P&L. But on some positions, I just prefer to protect the book, and that is something that just varies from people to people, right? Onto the strategic book, working kind of backwards. We already got the dollar Swissy, dollar Sing, just slightly kind of more aggressive kind of levels, albeit kind of risking the same kind of clips. I also decided to just fold the contrarian long cable. This is due to a few different factors. One, obviously, BOE being a lot more dovish. We know their last inflation point printed. I still like the weekly chart on this, but it just seems like it could be seen near-term downside before it starts to kind of move kind of back up. And again, I just wanted to kind of bank that kind of in essence. And then a new, very kind of technical kind of driven trade. Also, me liking the idea of potentially kind of structural weakening of the Swiss kind of franc, and technically, I like the Swiss equity index chart, which seems to kind of be breaking out, and that could kind of be interesting. And that's actually why we've added this on, also because we don't really have any long delta kind of exposure to equities. And that's the strategic book. And with that, let me please pass it to JK. Thank you so much.
Thank you, Kate. Okay, so we saw weakness all throughout last week until on the very last trading session, the US dollar index was finally able to break its losing streak after finding support at the 2015-2016 base, as well as the 200 weekly moving average. This is something that we've been highlighting for weeks now. The US dollar now trades at a triple bottom formation, with the RSI signaling that this is still oversold. So we look for gains ahead this week, at least. So the bias would be to continue to buy the dips on any weakness over the US dollar. Looking at the daily chart, resistance for the week could be served at the short-term red downtrend, which has capped USD's moves in April, then again in June. This week that comes in starting at 94.70 up to the 95 handle. Again, the 200 weekly moving average, which has defended the US dollar from further losses, combined with that 2015-2016 base, has given us a technical setup for now to see a broad USD rally. However, I'll highlight the next attempt of breaking through last week's levels here. We'll make it his fourth attempt, 1, 2, 3, and then the next one will be the fourth if we get one. Generally on the fourth time at breaking major resistance, or in our case support levels, it goes through violently, but for now we experience a tactical run. After a brief surge above its 200 weekly moving average, the euro reversed off its weekly highs to close below the 200 weekly moving average. This reversal and close below the 200 WMA is supportive of our view for the US dollar to extend its gains this week. One will look to sell any rallies over the euro this week, with each retracement level between last week's high to low to each serve as technical resistance. And that starts at 117.97, higher from where it's trading here in Asia, or just below 118, followed by 118.18, that's the 50% retracement level, then 118.40, followed by 118.66. Now, nothing has changed our longer term view for the euro. It is in a major bull market, but for now, given the extended session of gains, we look for a healthy pullback. It will be desirable for the euro to come back to test the original 2015-2016 breakout levels, which are here, or around the 115 handle. This would serve as a very strong support and buy level. After a brief break of the major May 2016 low, the dollar CAD found buying momentum build above its 200 weekly moving average and locked its first weekly gain in 5 weeks. The daily shows that it broke above a very short-term downtrend line. Upside target sits at 112.37 or the 23.6% retracement. Any near-term pullbacks would allow for buyers to support the currency starting at 126 handle down to 125.60. And after 2 weekly attempts at selling above the 200 weekly moving average, the Aussie is finding extreme difficulties in achieving this milestone as we see technical rejection of its weekly highs given the noise experienced at the 80 handle in 2015. On the daily chart, it trades below a mini double bottom. Support is temporarily found at the original May, June, July resistance trend line, as well as the first retracement level between the May low to recent high here at 78.90. Below last week's low, so below 78.90, 77.83 serves as next downside support, and we mark this 77.83 level down to 77.46 as strong buy levels, and the next wave of gains would potentially start off this zone here. The USD strength seen on the final day of trading was not enough to push the dollar yen higher to settle above its 200 weekly moving average, and this remains the challenge for the week ahead. As highlighted in last week's presentation, the dollar yen is trading below its 200 weekly moving average for the third time now, once here in April, again in June, and it's imperative this week that we're able to settle above 111.33 to argue for further gains ahead. Above 111.33 would sit the 200 daily moving average at 112.31, so another 100 points above that, 200 weekly. Earnings continue for our Aussie stock market, with our largest bank, Commonwealth Bank of Australia, due to deliver their earnings on Wednesday. We don't expect any change to the way our index has traded from May. Very choppy trading, continued consolidation between the 200 daily moving average up to 5,800. Only a break either way, so above 5,800 or below the 200 DMA is expected to then set a proper trend for our Aussie index. The S&P 500 consolidates in a pennant formation, as you can see here. With here Asia trade, we're seeing it trade above the upper pennant trend line. Now, applying the rules of pennant breakout, we measure the range between the trough to the peak of the pennant and apply this range to the breakout, as you can see on the chart. The end topside target, so 100% repeat of the pennant range, comes in at 24.95 or just below the 2,500 handle. It'll be very interesting to see how the S&P reacts from here. But given the technical setup, the probability is heightened for a higher move over the S&P in the sessions ahead. Last chart of the day, this is the same weekly chart from last week for gold. After breaking above the long-term 2011 downtrend in the prior week, gains were given back into the Friday close and now currently challenges this downtrend line that it broke. The weekly close thus becomes extremely important, as another weekly settlement above this weekly trend line will be desired by those gold bugs. The 200 DMA at 12.30, these levels here, is expected to lend buying support upon further weakness over gold this week. That brings us to the end of the macro call. As always, you can check out the replay. We'll be sending out the summary. Throughout the week, we'll continue to upload our comments, our analysis, and trading ideas on tradingfloor.com. I'm wishing everyone a profitable and a safe trading week ahead. Thank you.